Revenue smashed expectations, EPS beat estimates, and full-year net income surged 292%. Broadcom just delivered a flawless FY 2025 annual report, yet it opened down 14% after hours. This extreme divergence between earnings and stock price has shaken the market. Has the AI growth engine already stalled? Hey everyone, welcome to Stock Market Breakdown. Looking at Broadcom's wild moves last night, we don't need unnecessary emotions, we need cold, hard data. Many are focused on that 14% drop, but they are ignoring Broadcom's dominance in capital structure and the AI supply chain. Broadcom's performance in Q4 FY 2025 was extremely strong, with every major financial metric exceeding analyst consensus. The double-digit drop in stock price after the report isn't caused by a crack in the business fundamentals, is due to recent macroeconomic uncertainties, triggering market concerns over whether hyperscale cloud providers can continue funding AI capital expenditures. Simply put, Broadcom is paying the price for the entire tech sector's high expectation pressure. I see this drop as a classic case of a market panic rather than company deterioration. One fact is clear: Broadcom's financial statements reflect solid, already realized operating results. The price drop is mostly based on hypothetical future balance sheet concerns. For rational investors, we need to separate what is a noise from what is trend. Broadcom's AI semiconductor revenue grew 74% year-over-year this quarter, proving its irreplaceable role in the AI hardware supply chain. Currently, Broadcom is deeply embedded with the 5 largest hyperscale cloud providers: Google, Meta, Microsoft, Amazon, and the recently high-performing Anthropic. Specifically, Anthropic hasn't cut back on spending. Instead, it's continuously placing additional orders, with Broadcom totaling tens of billions of dollars, with order visibility extending well into 2026 and beyond. Pay attention to this Big 5 client list that basically represents all global AI computing power today. As long as these tech giants continue their arms race, Broadcom remains their unavoidable core supplier. The additional orders from a player like Anthropic send a very clear signal: the top AI unicorns and cloud giants aren't slowing down. Unlike NVIDIA's general-purpose class, Broadcom has long focused on customized chips. The XPU track. This model is optimized at the chip level for each customer's specific AI workload, as cloud giants try to reduce reliance on a single external supplier through self-developed chips and pursue higher efficiency and lower TCO. Broadcom's collaborative development model is becoming the preferred choice for major players. This puts Broadcom in a complementary and differentiated position relative to NVIDIA. Customized chips are Broadcom's real moat. NVIDIA sells products, Broadcom sells capabilities. For giants like Google and Meta, they don't need a universal chip, they need the chip that fits their algorithm best. By deeply embedding itself in customized development, Broadcom creates extremely high switching costs. Broadcom's infrastructure software business, after successfully integrating VMware, has shown incredible profitability. The segment now generates $27 billion in annual revenue, with a gross margin of 93%. By fully transitioning to a subscription model, Broadcom has converted formerly cyclical revenue into extremely stable recurring cash flow, even in years when the global semiconductor market faces cyclical swings. This high-margin, high-stability software revenue provides a strong defensive cushion for the company's overall P&L. We need to redefine Broadcom. It's not just a chip company, it's a top-tier software giant. A 93% gross margin means this business almost purely generates cash. This hardware-software dual-engine model has very strong risk resistance in the capital markets. When hardware markets swing, software is the ballast. When hardware markets explode, software amplifies profits. Financial data shows profit growth is clearly outpacing revenue growth. Gross margin has climbed to nearly 77%, extremely rare in hardware manufacturing. This reflects both high product value and exceptional operational efficiency. As scale expands, Broadcom demonstrates excellent financial leverage, meaning every dollar of revenue growth converts into an even higher proportion of net profit. I've always emphasized that Broadcom CEO Hock Tan is both a financial and strategic expert. He runs Broadcom as a highly efficient capital platform. Through precise and extreme operational optimization, he can push profit margins to the max. This powerful financial harvesting ability ensures Broadcom maintains extremely high returns on capital under any macro environment. While we can be optimistic about growth, we must also acknowledge potential risks. First is valuation premium. Broadcom's PE is significantly above industry average, meaning the market has very low tolerance for growth misses. Second is customer concentration risk. The bulk of AI revenue comes from just 5 clients. Any delay or strategy shift could have an immediate negative impact. Finally, competition from AMD and others cannot be ignored. This is the core warning I want to give today. Broadcom is a high-difficulty stock that's suitable for blind faith. Because it's so strong, the market's expectations are almost harsh. We need to watch not just current growth, but the marginal slowing of growth. If any of the big 5 start signaling a peak in AI capital spending, Broadcom stock could face huge pressure. Evaluating valuation percentiles and monitoring top client behavior is the key risk management logic for investing in Broadcom. Over the long term, Broadcom has delivered over 700% returns in the past decade, even with sharp short-term swings. Its AI customized chips and enterprise software dominance remain solid as long as AI demand logic hasn't fundamentally reversed. The current pullback looks more like a amicable market pause. Rational investors should see that this 14% emotion-driven drop is actually a rare long-term entry opportunity. Business fundamentals haven't broken, and core clients are still placing orders. That's the most important fact. To sum it up, this drop is more like a stress test that weeds out weekends. From a long-term perspective, this emotion-driven mispricing is actually a chance to build positions. Of course, this isn't specific investment advice. Lastly, I want to ask questions. Do you think Broadcom's current valuation has bottomed? Leave your detailed thoughts in the comments to pick professional insights to discuss. Like and subscribe to Stock Market Breakdown, and I'll see you next time.